Hi, Neil here, back again, and we're looking at part 2 of the WEF World Economic Forum Fintech Wheel, and that is insurance. In part 1, or in section 1, we looked at deposits and lending, but now we're looking at insurance, and we're interested in how fintech companies can, through collecting various pieces of data through sensors, smartphone technology, and through other technologies, to better price risk. And at the end of the day, if we can better price risk, then we can enhance the prediction of the probability of a bad event and the magnitude of the loss. And that's all we're trying to do. If we can better predict those two items, then we can better price risk. So let's go through and look at the areas where fintech companies and other technology companies are making inroads in terms of data capture that enables the better pricing of risk. Okay, here we are on the 6 clusters of the wheel of disruption, and we're up at the top here, right at the top, you got it, and this is insurance, and we are disrupting the traditional way in which insurance is sold and marketed in many ways. Let's start with telematics and insurance. What does that mean? Well, telematics is largely at the moment in the B2B space, and that's where things are really happening, where you're putting sensor technology into commercial vehicles like trucks, into cars, into taxis, into buses, to track and to gather data on driving behavior. Now, that data can inform many things. Number one, it can inform when trucks, commercial vehicles need to undergo maintenance, so you can improve the way in which you intercede to better maintain your fleet of vehicles. Now, that's important for keeping your vehicles on the road, and insurance that covers that. It's important that we have that sensor technology, that you have continual maintenance. Number two, this sensor technology can also provide information about your driving behavior. If you're a driver of commercial vehicle, or even private vehicles, if we know more about your behavior, we can better price that risk that is attached to that vehicle, and to ultimately you as the responsible driver behind the wheel of that vehicle. So telematics and insurance is a big area in which the B2B space is being disrupted, where we've got the sensor technology, we're collecting data, and we're better pricing risk and basically the insurance that goes on commercial vehicles. So the B2C space is also going well. Telematics is providing real-time data, which is superior to a police report on your driving. So sensor technology in the car can sense whether you are drunk, and then that can stop you from starting the car up. Wow, that sensor technology can track your behavior, whether you are speeding, whether you are driving carefully, and we could actually price the motor insurance accordingly. If you are a safe and careful driver, the sensors are going to pick up that your car is picking up slowly, it's stopping slowly, and in that sense, it's actually providing feedback to the insurance company about how responsible you are as a driver. And so that would enable the insurance company to segregate you as a nice, safe driver from unsafe drivers, and therefore possibly giving you actually cheaper premium on your insurance rate compared to more unsafe drivers. Wow. So you've got the sensor technology collecting data on your behavior, and then that's feeding forward into benefits for those who are behaving better from those who are behaving worse behind the wheel. Wow. So telematics and insurance is all about the generation of data. It's about the collection and aggregation of data. And then we've got data analysis, where we start to segment the good drivers from the bad. Okay, the good behavior from the bad behavior, and then we're going to evaluate those drivers. Then we can actually intercede on drivers that are behaving poorly by actually stopping their insurance policy, or actually adding a premium to the insurance policy if they actually go beyond a certain behavior driving record, like speeding too much within a month time limit, or within 1,000 kilometers, something like that. So you're actually pricing according to behavior. And this is an amazing way in which we are actually separating the pool of insured drivers from those that are behaving well, from those who are behaving poorly. Wow. Amazing. That's what telematics and insurance is all about. And fintech companies in this space are disrupting the traditional business model, where we insure all commercial vehicles, all cars, in the same way. That if the car is 2 litres, then you pay a certain premium. If they're 3 litre fuel capacity, you pay a higher premium. If they're 4 litre, you pay a higher premium. But now we are actually adjusting the premium according to your behavior. Wow, this is a totally new and original business model, made apparent or made available by the use of sensor technology. And you don't need to put special sensors in cars. All you need now is an app on your smartphone, and that's associated with your policy coverage, which is already registered in that app. And that smartphone, with its sensors, are picking up things like that, and speed and slowing down and speeding up, sensors like that, that goes into the app. That is just enough to pick up how dangerous or how safe you are as a driver in your vehicle. So we've got app sensor technology in the smartphone watching your behavior as a driver. Now, why would on earth you would sign up for such an app? Maybe because you get 20% off your car insurance premium, which could add up to a lot if you have a large car. Wow. Let's have a look in other areas in which insurance is helping to separate the good behavior from the bad behavior insured people, or help to separate those in good condition from poor condition, especially in the area of health insurance. Now, let's have a look. In this health insurance space, insurers would like to get your blood, ouch. See, got some blood here, all right? They like your blood. Now, how many of you, if I asked you, would you give your blood if you got 20% off your policy coverage? Maybe some of you say yes, but majority of you say, no way, you're not getting my blood. My blood is for myself only. We understand that. So you've got to be careful that it's not like a fintech will come along and they're basing their health insurance algorithm on the ability to test an insured's blood. That is a very difficult ask when you're getting into this space. If there are other sensor technology out there which can do a similar job or as good as job as getting your blood. What do we mean? Well, again, we're using smartphones, we're using data trackers, and to get a sense of what is your behavior. Is your behavior healthy or is it not? Are you in good shape or are you not? And once you start tracking your daily behavior with a sensor technology like this, and you register with an insurance company with a discount on your premium, there's an incentive there, then they can collect that data. And then over time, They could give you benefits as a result of your healthy behavior. Yeah, that works. That is actually working. And like Vitality Health on this slide here, look, just here, you can see it. All right, 20% cash back. If you are a Vitality Health member, you can get up to 20% cash back on healthy food items at your selected partner. Now, maybe one day you didn't want to buy healthy food items, so what do? You don't buy with your credit card or with your app. What you do, you take out the cash and buy the unhealthy food, but for the healthy food, you pay with your app. Of course, there is some funny behavior that these sensors can cause if once you are an insured person with these health insurance companies. But I want you to think about what is going on here. Telematics, predicting your driving behavior, try sensor technology in your smartphone when you're driving, sensor technology, Fitbit tracker, when to try and predict how healthy you are, or whether you are displaying those healthy habits when you go into the supermarket and you're buying vegetables versus buying chocolate or alcohol or something like that. Okay, what is this all about? It's all about adding more columns to the database. Remember, each row is an insured person. Remember, in section 1 on deposits and lending, we had rows for every person that wants a loan. And then Capital One came along and created more columns because they gave loans to a greater variety of people. They created a huge database, and then they're able to use that big data algorithms to predict to a much greater accuracy who should we lend to and how much we should lend to. And they ended up with that model being able to lend to a broader demography of people than what was traditionally lent to by banks. Now we can transfer that into the insurance model where we're creating more columns. That is, I download the insurance app, and now the insurance app is tracking where I go in the supermarket and whether I buy healthy food or not. Or it tracks me whether I go hiking on the weekend or whether I go bike riding or not. Now that's creating extra columns of data about my behavior as an insured person with the Fintech health insurance startup. Amazing. And so this is the business model of insurance. The whole business model, number one, is we're trying to predict the probability of a risky event, a car accident, the probability of me having a heart attack or a stroke. And then we're also trying to predict, okay, what is the magnitude of the loss? Okay, so there's the probability of the event happening, then there's the magnitude of the loss. Okay, and this sensor technology do a great job by tracking behavior, enabling to predict those two things. Now, I want you to think, if you're in this startup and you've got a business model in the insurance space, it's all about using sensor technology to get people to the starting line. In other words, I want everyone to sign up for this insurance program. I'm going to give you health insurance. I want to get you to the starting line. How do I get you to the starting line? Well, I'd like to check your blood. And you say, no, that's not going to happen. All right. If you join with us, we'll give you 10% off if you put on a smartwatch. We will give you 10% off if you maybe do a health report with a doctor so the doctor isn't giving the insurance company the blood, but the doctor, a medical professional, is taking the vitals of you and giving you a professional report to the insurance company. Okay, so it's sort of different from blood because you got the medical professional in between. All right, but ultimately the easiest way is to say, look, download our app. We will let you join our program for free for the next 6 months and the next 12 months, but then you go into the main program after 12 months. But during that time, you have to have this app. We will adjust this premium once we get to know more about your behavior. Okay, so we're trying to get people to the starting line with a basic coverage, and then we can adjust part after you have signed up for that insurance. And so the contracting can be different before and after. Why? Because we've got sensor technology to track your behavior. That's how the business model is working in the insurance area. And so some more details of Vitality Health status. When you start, they may start you as a bronze member. And then as a result, if you perform very well, if you behave very well, you can actually graduate to silver and to gold and to diamond. Now, of course, if you pay more money, you can actually upgrade as well. But there's ways in which they can bring you to a different tier, either by increasing the premium or by tracking your improvements in your behavior, which at the same time decreases the risk of the insurable event. Now remember, the game of insurance is to better price the risk of an insurable event. The less likely the insurable event will happen, the actual cheaper you can price that event. And then tracking someone gives you information about the likelihood of an event occurring. So these are the business models that are happening out there. Insurers will adjust premiums for going to the gym, buying healthy food, doing all these sorts of things. Now, of course, there's ways of getting around that, as I'll show you in a minute. But before that, insurers in the fintech space, they actually tried to actually say, oh, you want to join our insurance program? We will give you a discount if you allow us to access your Facebook profile. Why would they want that? To get more columns of data about your behavior, as if your social media profile is reflective of your behavior. That is, the likelihood of an insurable event. Wow, the extent that these insurance companies are going to find out about you, or the likelihood of an insurable event that they are insuring you against. Like, when an insurable event happens, they have to pay out, and they don't want that to happen. If it's more likely to happen, they want to charge you more. You remember, because when they pay out, they lose money. All right, so it's a likelihood of an insurable event that they really want to try and price. So they're creating more columns. Let us join your Facebook social media profile so we can understand who you really are, and creating more columns in that way. But Facebook has blocked these plans, and they said, no, you cannot do this. So it's amazing the extent that some of these fintech companies are going to get more columns of data about you. Wow. And so this telematics data provides a clear segmentation of risk, and that's what we're doing. And like, vehicles with the riskiest scores are 6 times more likely to have claims than vehicles with the safest scores. Now, interest in sharing device data in exchange for insurance discounts has gone up a lot. And look at that. If a digital pedometer, interest is very, very high. A smartwatch, very, very high. GPS watch, exercise equipment, sleep quality. It's amazing how things have changed compared to a decade ago or 20 years ago. It's amazing how much more data we are willing to share so we can get a better deal in how fintech insurers price the risk that we are signing up for, or the risk that they are signing up for, and associated with our health, associated with other events like a car accident and so forth. All right, so there's some insurance companies that are saying, no fintech, we're not going to give you insurance. So if you have a fintech, if you have a Fitbit or a smartwatch, you can get around that. How can you do that? Oh, there's many different ways. You could put this around an electric drill, turn it on, and this goes around and round and round, and it's equivalent to walking many kilometers. You get that drill going for 10 minutes every day. You know what I'm talking about. You may have tried this yourself. Or you put onto a dog's collar, take it down to the park, you read a book and let the dog run around. Okay, or put on electric mixer, a desk fan, or a rocking chair. So there's ways of getting around sensor technology. We understand this. So there's always going to be those who sign up for insurance who have bad intentions. Okay, there's always the good and the bad in this world. But generally, insurance companies have always been in this business and worked with those that try and play at the extremes of the rules that are laid down under the insurance policy. As you can see, a lot of insurance policies now, the conditions go on for many pages. All right, so let's go on to further health insurance. Insurers are trialing connected pill boxes to ensure that you take the pills as prescribed. Wow, because if you take the pills as prescribed, then that will minimize the chances of a risky event occurring. For example, a heart attack or a stroke or something like that as you get older. So it's in the best interest of the insurance company to know that you are behaving correctly and following the doctor's advice. Insurance companies have even gone further to think about putting a patch inside the patient that detects if a pill has gone down into your stomach to double check that have you taken that pill, because it's easy to take a pill out of the pill box and have the sensor saying, oh, you've taken a pill, but that doesn't mean you've swallowed the pill, does it? I know that some of you were thinking that, were you? Well, here's what they're thinking now. We need to put a patch here, all right, that registers if a pill has been digested in your stomach. And there's some sensor in your pill between that and the patch that talks to an app in your smartphone that says you've taken the pill. Wow. How many of you think would take that? Or how many of you would ask your parents to do something like that? Wow. This is a new age that we're talking about. But this is what insurance companies are trialing in some countries in the world. So this is scary stuff, because insurance, unlike deposits and lending, that was more the financing side of your life. The worst that can happen is you can go bankrupt. But insurance and lending, it's all about your life. It's all about car accidents. It's all about insurable events, acts of God, and catastrophes, pandemics, and lots of things that arise because of things like that. Wow. Because of that, it's a very sensitive topic in what fintech insurers are trying to do today, and there's regulations about what they can and cannot do. They tried to get information social media to get more columns on your behavior. Facebook said, no, you cannot do that. They're trying to get you to the starting line the best way they can without taking your blood. And then if they're able to track you after you sign up for insurance, then they can post contracting, adjust the premium year on year based on your behavior, whether you're driving a car, whether it's walking behavior, whether it's your healthy behavior, whether you're going to the gym, whether you're going to the supermarket and buying fruit and veggies. Wow. Is there any privacy? Not much left, is there? That's the scary thing in this area here, this area of insurance. Wow. be careful. Be very careful here. This is Neil. The second area of the World Economic Forum wheel, insurance. Stay tuned for the following 4 parts, which in the following videos are called part 2 and part 3. Like these first 2 videos were part 1 and called up into deposits and lending and insurance. But stay tuned for the final 4 segments under parts 2 and parts 3. This is Neil. Bye for now.